All right. I think we can get going. Welcome, everybody, to today's discussion. I sent an email this morning. I think it's not even quite fair to call it a webinar. It's going to be too exciting. I am super excited to be here today. We've got an amazing group of panelists to talk about working capital, which is an underappreciated but highly effective lever for your business. So, want to thank you guys all for coming. By way of introduction, my name is Austin Gardner-Smith. I'm the co-founder and CEO at a company called DryPoint. I'll tell you a bit about us in a second, but I do want to get right into our content. We've got a great group of panelists. Just a heads up on some housekeeping stuff. We are going to record this, so we'll send a video to all of you guys who are registered and those who couldn't make it. So if you need to drop for whatever reason, can't imagine what would be more important than this, but we will send you a link to the full video recording. It'll be available on the web. And if you have questions, please use the Q&A button in your Zoom toolbar. That'll allow us to address them. We're going to try and save a good chunk of time here toward the end for questions, but please keep them coming. This is your chance. We've got the top of the house at a lot of these firms. If you have specific questions that you want answered about products or ways to think about your business, please let us know. With that, we'll get right in. We have an amazing group of panelists from 4 different working capital or debt providers. They're going to talk to us all about their solutions. I'm going to have them introduce themselves in a second. We'll have plenty of time to hear from these folks about exactly what they do and what they're looking for. But I thought that it would be useful just to kind of ground ourselves in the subject matter that we're talking about first. We had a really amazing prep session last week and some pretty key topics came up. So the first thing that I want to cover today is just why working capital. What are we talking about? Why would you think about these different ways of financing your business as opposed to just going and raising money from friends and family? So I've got an illustrative example for us to kind of set the table. Then we'll open up. We've got a couple of questions that we'll have a roundtable discussion around, which I think will be really informative. They're kind of based off of the things that we hear most commonly in working with e-commerce founders. We want to hear from you guys. We'll open it up for Q&A as fast as we can and try and get everybody to get a little spice going. So in a bit of a shameless plug, just so you guys know what DryPoint is, why we're hosting a working capital webinar, all this stuff. We are a strategic finance platform for scaling brands. What that means is we basically help exclusively e-commerce and omnichannel consumer brands with their strategic finance, the forward-looking side of finance, how we plan for the future, how we think about revenue growth, how do we think about inventory, and importantly, funding the business. So if you are finding yourself copying and pasting data back and forth between spreadsheets, downloading data from 16 different sources and trying to piece together a model, pulling your hair out when an investor asks you to produce your financials or some analysis, give us a call. That's all stuff that we can help with. You can see some of our client list there. We're working with a ton of amazing brands. All right, enough about us. What I wanted to do is share a quick example of a real brand to kind of ground us in the working capital ideas. My wife's name is Kelly. She likes to run. So I made up a fictional business called Kelly's Kicks. So let's imagine, Kelly started a running shoe business and we've got some nice growth. So I try to keep the numbers really simple here. Again, this is not how DryPoint does financial modeling for the record, but we put a couple of things together. For the sake of argument, let's assume that Kelly's got a great business here on a net revenue line. Over the first 5 years of the business, she goes $1 million, $3 million, $10 million, $30 million, $50 million. Nice growth trajectory for the business. We keep all of the margins completely stable. So she's got 65% gross profit margins. We're spending about 30% of revenue on marketing, about 20% of revenue on OpEx, and generating about a 15% operating income margin. So we've got a nice business. Let's assume we can get a nice valuation. Again, I've kept the math simple and say, hey, let's assume we can get 10x EBIT on this business. So we see a valuation curve there. The only little blue line is I said, well, no one's going to raise money at a nothing valuation when they get started. So for both of the scenarios that we're going to look at, this is the business that we're assuming. None of the fundamentals of the business change. We're not assuming that in scenario A or scenario B, she gets any better at running the business or the business gets more profitable or anything like that. Exact same business, but what I wanted to look at and sort of illustrate is 2 different ways of funding this business. So you can see the second and third to last lines on this little model down here. We've made some assumptions about how much capital she needs to run the business. Basically, a combination of funding ad spend and marketing investment and funding net new inventory purchases. So there's always some money that you're going to need to keep the business going. And so we've made an assumption about what that is. Now, here's a couple of different scenarios. So to keep it simple, in scenario A, let's assume Kelly funds this business with 100% equity. So in year 1, she raises 600 grand. Year 2, about 2 million, then 6 million, then 13 million, then 20 million. not a totally realistic scenario, but she's funding all of this growth and this capital for the business with equity, selling shares of the business to an outside investor. And over time, you can see that ownership line starts to go down. So at first she sells 20% of the business, but by the time we're out here in year 5 and she's doing 50 million, she's only left with about 13% of the business. And so her take home kind of ownership dollar before tax, let's say she sells the business in year 5, she makes about $9.8 million. On scenario B, let's say that she uses a little bit more strategic mix of debt and equity to fund that business. So as the business grows, she's able to layer on some debt into the business to start funding that. So she doesn't have to sell shares of the company to purchase inventory, to buy ads, to continue growing the business. Again, exact same business from a fundamental P&L perspective, same revenue, same margins, all of that stuff. But she's taking less dilution along the way. So by the end of this path, even though she's still raising some equity, she's left with almost 40% of the business. So even after we take into account the cost of that debt service, I've assumed an interest rate of 15% on all the debt that she takes, just to keep it simple. She's still ending up in almost a $19 million exit on the same exit valuation, right? So she's able to keep more of that money. A very simple way that my co-founder actually used to talk about this was, the founders pay for the equity, the business pays for the debt in some way. So over time, it makes sense, especially in a consumer goods business where we have lots of working capital, to start thinking about how to deploy debt as a strategic and an effective tool for your business. There's lots of reasons to do that. You'll have to raise less money. You'll end up with more ownership, all good things. How do we do that? What are all the different flavors of different working capital that we could look at to do that as a business? Not all flavors of capital are created equal. They are different types. And there's lots of ways to think about this. We're going to unpack all of that here in a minute, but a very simple sort of heuristic that might be helpful is to think about the spectrum of debt products available to you and kind of this 2-axis model. So on this side, we see sort of cost or rate. What's the cost of that capital? How expensive is it? How high is the interest rate in very simplistic terms versus how much security or covenants are there? So security or covenants is basically describing from the position of the lender, how secure do they feel that they're going to get their money back? What kinds of protection do they have in order to recoup the money that they're lending you? So as you are over on this side of the spectrum, you might have credit cards up here, relatively high interest rates, but almost no security. If your business blows up tomorrow, those guys are the last guys to get paid. They don't really count on seeing that money back. They have to account for that with a higher rate of return, a higher interest rate to the end borrower. On the far end over here, you might have something like a bank term loan. So once you get big enough, a very large bank will be able to use their balance sheet to lend you money. They are going to ask for lots of security, up to and including taking full ownership of the business in the event that something goes wrong. But in return, they're going to offer you a lower rate, a lower cost of capital. And I think we've got a really interesting discussion today. We've got folks kind of all across this spectrum at different points. So as they introduce themselves here in a second, I'm going to ask them to kind of roughly position themselves on this spectrum so that we can get a mental model for where everybody fits. I decline to actually place anybody on the spectrum myself for fear of extreme retribution, but we'll let everyone do it for themselves. So I'm going to shut up for a second and make sure that you guys get a chance to hear from these guys directly. So we'll kind of just let's go left to right on the slide. Why don't you guys introduce yourselves, give a brief background, talk about your firm, your product, and I think maybe the one or two kind of most important pieces of information or aspects of the business that determine whether or not a company might be a great fit for you or not.
Sure. I'll take the lead here. Thank you, Austin, for setting this up. And I think this is just a great way for brands to understand the full spectrum of products out there. Perhaps not really well known is we actually play nice in the sandbox together. And you can find that we're quite complementary with a lot of other debt providers and other options in the market. My name's Alex Ordea. I've been a lender and an equity investor for over 22 years, broad swath of different markets, but really focused on e-commerce and direct-to-consumer at DeepOcean. Partners here, our primary focus is really a graduation product. Once your business has gotten to a certain size and scale, you're looking for something that is much more of a bespoke, custom-tailored solution, like a fine suit. That's really what we offer. So we're focused on brands that are doing north of 10 million in revenue, upwards of even 150, even 200 million in revenue. Basically sustainable businesses that have good unit economics, a good repeat customer behavior, and a good product. Typically do $5 to $25 million facilities. Will stretch down as far as $2 million or so. And our typical cost of capital is in the teens, low teens to high teens, depending on the stage of the business. 2, 3, 4-year term loans, revolvers, line of credits, and other kind of bespoke products.
Awesome.
Yeah, I'll go next. My name's Andrew Curtis. I'm the CEO of Clearco. Clearco was founded in 2015. We created the revenue-based finance or RBF market for DTC e-commerce businesses. That was done in 2018. Since then, we've originated several $1 billion of advances to our customers. For those of you who aren't familiar with revenue-based finance, it's a different way to describe a product that's been around for a while, which is a merchant cash advance. That product has a long history, especially in financing brick and mortar businesses. The product is not a loan. Rather, we make advances of capital to our customers, which they then pay us back as they generate revenue. Our customers are exclusively DTC e-coms, often with revenues between 10 and 25 million. But sometimes we have larger customers, some that are above 100 million, and sometimes smaller, less than 5 million. When they're smaller, they often cannot access traditional bank financing markets. This touches on Alex's point about where we fit in the spectrum. And on that chart that Austin showed, we're kind of on the farther left-hand side, up the curve a little bit. Our core offering is our invoice funding product, which enables our customers to upload invoices, which Clearco then funds directly. Typically, customers are looking to fund payments to vendors for inventory costs, marketing expenses, or logistics. Other key features of our product, our product maturity or tenor is 4, 5, or 6 months. So when you take an advance from us, you will pay that capital back over 4, 5, or 6 months. The product is unsecured. So different from Alex's product, for example, we do not seek liens on a customer's assets, and we do not ask for personal guarantees from business owners or founders, versus many of our revenue-based finance peers who typically debit a percentage of our customers' revenues. Our customers make fixed payments to us. So that's a critical differentiator. We believe that fixed payments allows for greater predictability, and that allows the customers and business owners to better plan for their business. The other thing I would say is versus traditional cash and bank MCAs, when you take capital from us, you're actually paying the cost of capital when we deploy the capital. So we don't just give you a lump sum commitment of dollars. You're actually uploading an invoice. We pay the invoice. And at that point, when the funds are dispersed is when you start paying us. So there's no hidden fees and you're only paying for capital when it's being put to immediate use. The final thing I'd just say about Clearco is we've been around for a while and we like to think we created the category. We know that for sure, but we like to think we're the most experienced, credible, and creative player in the revenue-based finance space. So nice to be here and look forward to answering lots of questions.
Andrew, just sort of based on that product description, a lot of that in terms of the actual product dynamics has changed for you guys over the past 18 to 24 months. Is that fair to say? So
absolutely. So we were Clearco 1.0, as we call it. Our product then was more of a traditional cash and bank financing product. So a customer would come to us, we would give them a capacity number, and then they could draw on those dollars from us. And we would immediately start debiting their revenue accounts on a daily basis. Today, you pay us back weekly, but more important, you come to us with an invoice after we've told you roughly what your capacity is. You upload that invoice and we pay that specific invoice. That represents a discrete extension of credit or a discrete advance, and then you pay back that discrete advance over 4, 5, or 6 months. So it's pretty different, but still under the revenue-based finance category.
Awesome. All right, Andrew Connaughton, talk to us about what you're up to at SVB these days.
Absolutely. So just a quick background on myself. I've been in the credit space for about 10 years. Before this, my foray kind of into the category was at a startup goods lender called Assembled Brands. So happy to touch on that. That was back when Clearco was Clearbank a couple of years ago. We used to see them out there as well. Definitely agree with what Andrew was saying. The kind of original receivables-based finance or revenue-based finance, I should say, option. I've since moved over to SVB, obviously a bank. So further to the right on the kind of yield security curve, probably on the opposite side of Clearco. And the two products that I think are in scope here for the audience are the venture debt products, which I think is what folks probably think of when they think of SVB. It's an equity-like instrument, the way I think about it, typically 4 years, term loan, no covenant. There's a warrant component. So very flexible in terms of what you can do. Like I said at the beginning, a bank, we take a first lien interest in the businesses. We often work with some other debt providers out there in a subordinated capacity, pretty flexible offering, little warrant there to compensate for that equity-like risk. The other product is traditional kind of working capital ABL, receivables based. Once these brands go omni-channel or inventory, that's often where we start and kind of have a hybrid and layer in some POs there as well. Again, senior secured, sometimes work with subordinated lenders. I think the major differentiator here versus some of the other folks on the call is that we do require a financial sponsor. So typically a VC, generally ones that we know. A lot of times we'll do deals with ones we're not as familiar with. But that is probably the number one criteria that we need to see at SVB, which sometimes kills me because there's a lot of great bootstrap brands out there. But that's kind of what we're working with. Appreciate you putting this together. That's the quick rundown there.
And so for folks thinking about it from a maturity curve, probably going to be a little bit later in that company life cycle where you have a financial sponsor, you have a little bit more financial history to be able to meaningfully engage with you guys.
Yeah, I mean, we'll start at the seed stage. So it actually can kind of run the gamut in terms of the life cycle, if you will. So seed all the way to kind of Series C, start seeing funky things once you get to later on in the alphabet there. But yeah, we can start early with both the term debt, and then you kind of need in our space to have a little bit more traction before you start levering working capital. But yeah, I think you're generally accurate there. Awesome.
Okay, Mark.
Yeah, absolutely. So Austin, yeah, thank you for inviting us to participate. This is great. And seems like we've got some really good panelists and excited to get into the discussion. So I'll try to keep this brief. So Steel Capital Management. My partner and I founded Steel Cap in 2020 in order to provide growth capital to direct-to-consumer brands. The companies we finance are typically doing somewhere between $2 million in revenue on the low end up to $75 million on the high end. The way we finance these brands is by providing committed term capital, secured term loans to these companies, ranging, I guess, from the small end, again, 250,000 up to 6 million with a term of up to 2 years. So kind of going back to that graphic of where do we fit on the curve there, we're probably between Clearco and DeepOcean for lack of a better way to differentiate, but somewhere kind of in the middle. In terms of how we think about the term loans that we provide to companies, we try to pride ourselves on being creative and more solutions oriented by working with potential borrowers to figure out a structure that is best suited for them rather than providing a standard off the shelf product. So for example, many of our loans have additional committed delayed draw tranches the company can access upon achieving certain milestones like revenue growth, profitability, or an equity raise. A lot of times that provides some much needed comfort to founders who want to go out and try to find the right partner that can grow with them. And they know that if they actually execute on their plan and they are successful, that capital is pre-committed. They know it's there and they can rely on that. So they know that they don't have to basically stop their progress if they're in the middle of executing on something that's really taking off. The capital is there to support them. In terms of the way that we think about which brands are the best fit for us, we try to take a no one size fits all approach. So we don't have a strict algorithm and we don't base things purely on revenue or inventory or lend a percentage against that. We try to look more holistically at a company and assess the credit risk. We look at factors such as all of your different revenue streams, profitability, assets, equity support, founder's background and experience, et cetera. So for example, this has allowed us to participate in situations that don't fit cleanly necessarily for other lenders. So we finance beauty brands that are mostly wholesale, as well as clothing brands that are exclusively direct to consumer. From a relationship perspective, we don't have an algorithm and we pride ourselves on having very strong relationships with our borrowers, which makes us be very selective in which companies we choose to partner with, because we firmly believe that investing in high quality companies and relationships generates the most value. The way that we've been successful in the past is by partnering with good growing brands and continuing to finance them. So adding additional tranches, upsizes, refis as they execute. The things that we look for when looking at a company and going through the diligence and underwriting process, we look at all the same things that typical other lenders will look at: financials, asset reports, et cetera. However, the more transparency and additional information that you can provide us, the better understanding we'll have for the company. And we'll be able to give you the benefit of that. Because we don't have a strict algorithm, the more information that you can give us, the more we can incorporate and the more tailored we can make a solution. So I was describing our model to a friend once and he said, oh, it's like someone walking into a McDonald's and ordering sushi. Even though they're willing to pay $100 a roll, McDonald's is not going to serve them sushi. We'll try to make the sushi happen.
I love that. Is it, is there like is it sub a million on the table, post a million? What's the most useful heuristic in sort of someone determining whether or not they're even in the consideration set for you guys?
Yeah, we're not going to take like idea risk or pre-revenue risk. So mostly we're looking at companies that have established a product market fit and they're looking for funding to accelerate that growth, kind of really lean into the J curve inflection point, and they need money for inventory or marketing, not necessarily completely speculative, new product development or even understanding whether or not this market exists for them. We want a company that actually has shown that and proven that out and then needs funding to accelerate growth.
Awesome. Well, thank you guys all so much for sharing that. If you guys have questions for any of these panelists about their specific products, feel free to ask them in the Q&A. We'll also make sure that you guys can get in touch with everybody afterwards. So I want to jump into just some discussion. We've got, I think, a lot of things happening in the working capital landscape. We've had a rapidly changing market, both in the credit markets in terms of the rate environment and what we're seeing as far as what people are willing to finance in D2C. There was an article last week that got a lot of traction in modern retail about sort of all of these zombie brands that have either raised too much money or are carrying too much debt. In my opinion, the death of D2C and the death of e-commerce is greatly exaggerated. There are hundreds of thousands of great operators in this space. I'd love your perspective, and I'll open it up to the group on what are the big changes in the capital landscape over the last, call it 18 months in e-commerce and consumer specifically. What's changed? How has the rate environment affected you? How has the rate environment affected brands? What are you guys seeing as sort of the macro trends in the space around capital?
Happy to take a stab at this one. So, the very obvious 2020, 2021 heyday of VC funding e-commerce businesses is clearly left the building. As a lender, of course, we need to ask ourselves, if it's not good enough for equity, is it good enough for debt? That's kind of one of the principal questions that one would ask. But you need to dig a little bit deeper, peel the onion back and understand why that is, right? I think the venture equity markets are certainly a great source of early stage capital, but it's also a very blunt tool, right? So, obviously with the attrition rate of portfolio companies in the VC landscape, you need those outsized returns to kind of make that call option really work. For ourselves, we think, and exactly what you said, Austin, there are so many great brands out there. And it doesn't mean that they're a complete failure if they don't achieve unicorn status, and the vanity of that and everything, I think, as you illustrated in the working capital example you put together, oftentimes means that you own a substantially smaller portion of your business as you continue to, grow or, grow too far into your market. Unfortunately, media selection bias kind of creates this issue where we look to the companies that went public, right? Or others that have splashy headlines. But we find so many great brands, whether they're sponsor-backed, VC or private equity, or oftentimes really just bootstrapped. And to some extent, they're deathly afraid of venture capital, right? The disalignment in cap tables. And, I've always cautioned founders that high valuations may make you feel good in the short term, but they kind of preclude your options in the longer term. So, obviously the venture equity markets are a big factor. The other one I'd say is lenders have a feeding frenzy these days of very large opportunities that they can deploy, especially, the private credit landscape has ballooned to 1.7 trillion in size. And those very large scale lenders, they don't really want to come down market, right? And they're too busy finding really good yields, really good returns elsewhere. And so nobody wants to do the work, right? There's, especially in our product, right? There's a thorough process. I don't want to, pretend like we could fund you in 48 hours, but, we really want to get to know a business like a real institutional firm. So because of that, I think, and because those costs of capital have gone up for even substantial firms, it's the dog wagging its tail, so to speak. Of course, in the kind of costs of capital that I think we're speaking of, it's less impacted by rates because it's so far removed from that risk-free rate, but there is still some impact there. I'll pause there.
Yeah, I would add, I think one of the, Alex has hit the nail on the head in terms of retraction of VCs from this market. But I think the good news, hopefully for a lot of our audiences, there are lots of different capital providers, a lot of whom you're seeing on this call, who have different products that fit different needs, that fit different companies at different stages in their life. There is a fair amount of capital aimed at that space. And there's an evolution and a growing sophistication in terms of what products we can offer smaller customers. Like Alex made a comment about not funding in 48 hours. Well, Clearco can fund in 48 hours. And so that's great for certain customers, maybe not great for others. In that universe of alternative capital providers or working capital providers, we love to work with firms like Alex's and with the SVBs of the world. So I think it's really an interesting time for customers and a good time for customers. People like to focus on the high rate environment and retraction of VCs or equity investors. But on the alternative working capital funding, I think it's a great time for customers.
The only other thing I would add on the change in the capital landscape is similar to what Alex said. It's not the capital, especially equity capital, is not as free flowing as it was in 2021. And I think that the change, not to say that there's less capital available in general, because like Andrew was saying, there are a whole bunch of different capital providers and different ways of funding businesses. But I think the type of capital has changed the behavior and the way in which brands are looking to grow. So in 21, when there was a ton of equity capital available, brands were more leaning into growth at all costs. Now that the capital providers have shifted more towards debt, the brands are being, I don't want to say more responsible, but more towards sustainable, profitable types of growth, even if it is lower. They're not getting pushed by VCs for the unicorn exit. And having a sustainable, profitable brand is much more important. And from a lender's perspective, that's a lot more financial. Knowing that there's a brand, good unit economics, if they're not growing 1,000% a year, if they're growing 50% a year or 20% a year, that's still a very good business. A good business that's growing can be funded by debt and the owners can retain a lot more equity. And then when they look to eventually exit, if you're trying to exit at $1 billion or $2 billion, there's not too many strategic acquirers out there for $2 billion plus brands, but there are a decent number of acquirers for brands exiting in the 75 to 200 million type range. And that's a very good exit, especially if you retain a lot more ownership of the equity.
100%. I think from my seat, one of the things that I've seen change in the landscape is the overall capital IQ of founders, capital responsibility has gone up, right? So you've got founders with maybe a little bit more scar tissue, but a lot more intelligence in terms of the way they're thinking about things. And I think we've seen a response in the capital markets, which is people having more nuanced products, people being willing to take different kinds of risk and do more interesting things. I think the flip side of that, having more flavors of capital available and having the many different offerings can make it more challenging for founders and management teams to try and understand what's out there and then to compare their choices, because there is such a diversity of options that it's very difficult to compare these things apples to apples and even to understand which ones might be a fit for you when you go out to market. You know, first you make a long list, you end up with 60 people and it's hard to even know who to talk to. How would you guys counsel founders or management teams in terms of how do you figure out who to talk to and what kinds of capital you might even want to consider? And then let's say you get 3 or 4 different offers that all have a little bit of a different flavor to them. How do you think about comparing these offers to each other and making the right decision for your business?
One of the things that I say to a lot of founders is, as I see similar patterns in terms of the 4 stages of what a founder needs. First is access almost at all costs, right? Anything is better than equity. And you need to get going. You want to get some leverage. Second is flexibility. Is that lender going to be able to be accommodative to the way that we want to operate the business? Are there any other kind of specifics that they can help us with, right? I think the term lender versus capital partner, there's an important distinction there in the sense of how different lenders interact. Third is scalability, right? Is that lender a relationship that I'm going to have to refresh over and over to keep going? And then finally is cost, right? And I think if you have enabling capital that gives you that flexibility, gives you access and availability, oftentimes I find founders that are less concerned with cost. Of course, at scale, you start to really get greedy when the dollars are large.
Makes sense. It's interesting. So cost being the fourth, I think most people's initial heuristic is to say, okay, I want to try and find the lowest cost of capital. And we're often counseling sort of like, well, you need to get the money first, right? Like if you don't get the money, it doesn't matter how cheap it is.
I think, Alex, it's a good way of looking at it. I would just kind of take it one step further and say, don't over-index on any one specific term. Look for the offer that actually addressed the thing that you're trying to do. So when lenders ask for what's the use of proceeds, be able to tell that story and have the lender see the vision of this is what I'm trying to do. This is what I need the money for. And then have them basically come to you with a solution of, does this make sense? If I'm giving you 3-month money, but this is a 6-month project, does that make sense? So what I mean by that is even looking at kind of the 3 kind of bigger, shinier aspects of an offer, meaning the size, the term, and the price. Don't over-index on the size, don't over-index on the price or the term. If someone's offering you the most amount of money, but it's completely uncommitted and the line can be pulled at any point, understand how that could potentially impact your business when making the decision and try to approach it from an overall perspective. Even if any one term is not necessarily better than one of the other offers, the thing that fits and works the best with your business is typically going to be the one that's going to be the best for you.
Yeah, invite the founders as you assess options for funding is take a step back and figure out like, okay, as Mark was saying, like, what are you trying to solve for? What is your ultimate priority? This is where people like Austin, resources like Austin are great sounding boards because he can help you figure out like, okay, what's actually important to you? Is it the amount? Is it the flexibility? Is it the rate? Like generally rate should be kind of like third or fourth per Alex's kind of hierarchy because there are, especially for growth stage companies, more important factors out there, and figuring out what actually gets your company to the next level of drives enterprise value is going to be more important than 200 basis points or whatever it may be. I think Austin, like your role as the shepherd, the kind of capitalization shepherd is super important in terms of like guiding these conversations and being like, look, don't just go out, get 7 term sheets, put them all in Excel, like compare terms, this box, and try and like maximize each one, which I've seen people do, and just creates like a kind of terrible experience for everyone. Come to the table with a priority, like really looking to solve for this. I want ultimate flexibility to run my business, make decisions, kind of see around the corner, et cetera. And then, like I said, utilize Austin to figure out how to get there and who the right parties that you could be speaking with.
Yeah, I think that 2 things just to chime in. One, I think the sources and uses matching is super important. I think that's, it's kind of like in some ways capital 101, but it often gets overlooked in terms of there are certain things that it makes sense to go raise equity capital for. If you want to build a net new manufacturing facility that has some novel process or innovation that's going to create a strategic moat around your business for the next 15 years, there's absolutely a reason to go fund some of that with equity. But if you're sort of funding inventory purchases and marketing dollars with equity dollars, well, you're just going to have to sell more shares the next time you want to purchase inventory, right, on these sort of continuous operating basis. So understanding the different places where you need that cash and not just the actual dollar amount of cash, I think makes a huge difference and helps founders kind of break it down a little bit. So that's one of the first steps that we often counsel. And then I guess my only pushback, and this is not to pick on you, Andrew, but sometimes I think it can be valuable to make that grid so you can see all the options together. And the other question I would have and put back to you guys is how much flexibility is there in these terms, right? Like often I think founders will get a term sheet and sort of think, well, that's it. Like that's what's on offer. Do founders have room to negotiate on these terms? Is there wiggle room when you're talking to a capital partner? And how should they think about approaching that discussion with a potential partner?
The devil of credit is that you can massively overstructure everything. When we speak with borrowers, it's all about their sensitivities. If they want a lower rate, maybe they want a little, less capital. If they want a specific structure or an interest-only period or other things like that, everything's negotiable. With certain lenders, right? I think of us as debt as a service in particular, as opposed to as a product. Not denigrating the products. You go to the supermarket and you buy the thing that you're looking for off the shelf because that's what you want to eat today, right? So we think about it very much the same way.
Yeah, I would say for us, it's a little bit different. So our invoice funding product is incredibly flexible to begin with. We're not asking for liens, not asking for security, not asking for personal guarantees, and we make decisions within, we can do it inside 24 hours when someone connects their accounts and starts providing us information. So the product's very much inherently flexible. So when we get to the maturity or the tenor of the product, our advance and the price, we're more rigid, right? We're not going to engage in customers who are seeking capital in under 24 or 48 hours and say, oh, well, we could do this. We have flexibility on pricing, but like on our tenor, it's 4, 5, or 6 months. We don't deviate from that, as an example.
And regarding like the negotiation, sure, you can negotiate a lot of things with multiple different types of products. I've also seen founders drag out negotiations for 2, 3, 4 months, end up paying a substantial amount of the capital that they're receiving to their lawyers and negotiating legal points that may or may not even come to fruition ever. So I would say that I would hope the reason you're taking the capital is to execute on something. But the longer drawn out negotiation process just bleeds the company, pushes off the execution of that, makes everything more expensive. And ultimately, if you're able to communicate the vision to your lender and have them basically be on board with what you're trying to accomplish, similar to the way that you would stage a house if you're trying to sell it. Have the lender like understand exactly what you're trying to do, get them to buy in, and then hopefully be able to get to a solution instead of a long drawn out 3-month negotiation that ends up costing, 12% of the capital amount just in legal fees.
Yeah, and that's the point Andrew Connaughton was making when he said, take a step back, think carefully before you engage, do some planning, and then you can act decisively once you engage different, a handful of financing sources. Because I think for so many customers, especially the customers we see, they're growing very rapidly. They need to make decisions rapidly around their capital sources and capital planning. So the more planning you do up front, the more thoughtful you are, the more decisively you can act.
Yeah, if you're waiting till you're out of cash, it's too late. I think your choices are fairly limited at that point. So there's just a quick plug. And I think there's tons of variability in how good the cash forecasting is in a lot of these brands. And sometimes people get snuck up on with this stuff. And so I think it's hard to, when most people think about the timing of running a process to find the right partner, they think about, okay, from the time I submit the application till the time I get the term sheet back, or what does that timeline look like? I think you do have to bake in, some significant time upfront to say, okay, let's do some planning around this, really make sure that we have our game plan over the next 12 or 18 months lined up, make sure that we have the sources and uses and where that capital is going to go. And that'll allow you to approach the right groups. I do also want to just touch on one thing that we were talking about in comparison that came up early. It came up a lot in our prep call, which I think is often overlooked as well. Most people go into this search with the idea that like, hey, maybe I'm going to find one partner. I'm going to find one right partner instead of thinking about creating a capital stack, for lack of a better word, that can work for the business. And so we talked a little bit about interoperability of different styles of capital on our prep call. I wanted to just raise that here and see how you guys think about working with other partners, or how you think about building a multi-tranche or multi-partner capital stack for a brand, especially as they grow.
I'll start. I think number one, we enjoy working with other capital providers. We always think that there's a place for different forms of capital for different purposes. We have one customer that has been a longtime customer of ours, and they like us to pay marketing expenses. That's what they use us for. And they love the fact that we're unsecured. Now, the business also makes capital investments. And so it's actually buying manufacturing equipment, and which is a little bit different than many of our customers that are sourcing inventory from overseas. So these guys are buying valuable, expensive, hard equipment, and they use bank financing for that, equipment financing or local bank to finance that. And they view it as bifurcated. We each have our role, and we fit well with that other traditional secured bank lender on the equipment.
Yeah, I'll say also, Andrew and I are talking about deals together, Mark and I as well. There's different ways that lenders can play together, and it doesn't necessarily need to create a gargantuan amount of additional complexity. But we always have an allowance for credit cards or, payables or some sort of MCA, RBF type products, subordinated debt, other things along those lines. So it's not this, monolith that can't be molded. We're a very deep analytical data science driven lender. And so for us, be objective, right? Whether you're selling a subscription vitamin or eyewear or clothing, for us, it's all about what that data tells us about the business. And when we build that pro forma, what the debt load of the business can sustain. We can tweak up and down the amount of availability that we have to kind of fit some of the other flexibility that something like a Clearco invoice payments product could do as well.
Yeah, I think customers should be very wary of dealing with working capital providers who will not work with any other providers, because at the extreme, there's an example of this in the marketplace right now, where a peer of ours would only allow their product in a customer's capital structure, and now they're experiencing some challenges of their own. And so then suddenly the customer says, oh, wait a second, you told me I couldn't work with anyone else, but you're experiencing challenges, financial challenges yourself. So where do I go find capital? How do I get out of this box? Because I'm trying to grow my business, and the capital I thought I had from you isn't there anymore. So I would always counsel customers to be very thoughtful about engaging with a single source financing party.
I would say, actually echoing both Andrew and Alex's points, I think it's good to work with other lenders and to have multiple relationships and have some of that diversification. I would say that, at least from the way that we think about overall leverage in a company, that's the piece that's going to really determine whether or not we can participate in the senior or subordinate capacity or allow another lender to participate, making sure that the overall leverage of the company doesn't materially degrade the credit quality that we had underwritten to begin with. So barring that, if there's a real good use of that capital, if there's a clear payback, from the investment that they're making, great, bring on as much capital as you need in order to accelerate the growth and execute on those projects.
What's like, do you guys have and this is not for your specific products, but like for let's call it, a 10 to $50 million brand that's growing, take the sort of Kelly's Kicks example, a brand that looks like that maybe isn't doing quite that well. What is the sort of rule of thumb or finger in the wind as far as what do we think the right amount of leverage to put on one of these businesses responsibly is? What metric do you use to think about it, and what's market? I guess flipping it even further would be like, okay, if you guys were starting one of these brands, knowing everything that you know about debt and knowing everything that you know about risk, how would you think about capitalizing it? What would be the ratios that you'd look at?
Also, I feel like you're asking that question to the wrong panel. I mean, maybe speaking for myself, I don't look at a lot of companies that print to EBITDA. So Kelly's Kicks, I don't think would be kind of in our wheelhouse. A lot of loss-making firms that we look at. So for a venture debt product, it's kind of sized based on the last fundraise round that they put together. And then on the ABL, it's kind of, self-fulfilling prophecy in terms of sizing, just given that you're basing it off the working capital assets. Yeah, in terms of EBITDA is not something I've looked at in many years. So fortunately, I don't know if there's a great rule of thumb there, at least from my seat.
Maybe I'll add a comment. A lot of businesses that we've seen over the past 12 to 18 months have had to re-rationalize their plans, right? Because of equity drying up in the funding markets. And so we've seen these businesses, and I think the founder mentality that we often see is, I'm going to push growth as far as I can while still being sustainable, right? We see a lot of businesses that have come within that plus or minus $1 million or so in EBITDA per year. And so our approach to underwriting is to understand how defensible that business is. One of the types of businesses that we really like is businesses with a lot of repeat customer behavior. And e-commerce and SaaS, while very different in some regards, the more that repeat customer behavior kind of exhibits itself, we all know what performance marketing costs and the customer acquisition for new customers. If you can throttle back on that marketing spend and just kind of coast or just not grow it at a similar rate, a lot of that goes into our calculations. And I think one of the myths in the market is I've come across founders that are like, you want to foreclose on our business or this or that. I could promise you that no one on this call wants to take the keys to any business. And we certainly aren't the e-commerce operator experts here. Putting the right amount of debt on, and sometimes it's just a very frank conversation. Like, here's what we're seeing in the data. Here's what we think you could be doing. And sometimes it's the opposite. It's, look at this treasure trove of analytics that we've uncovered. Look at how much more you could spend in this kind of channel in marketing, and you should be going for it, right? So I think we want to see repeatability and predictability in a business's cash flows or performance more broadly. And that's what gives us conviction to advance more or earlier or drop rate or do whatever the case may be.
I was hoping somebody was going to give me a magic number, but you guys are all too smart for that.
Well, I'll tell you that we look at a lot of debt service ratios. So we'll look at the total amount that a customer is paying to service either a revenue-based finance product or a loan like Alex, Andrew, or Mark's. And then we'll look at that as a percentage of revenue. We use that among a bunch of other metrics and kind of machine learning based tools. But that's for us, that's a very simple one that we look at regularly.
And is there a number or like a median threshold that you think is kind of healthy? Not to say it's a plus or minus.
I think we get nervous when we see that number above 30%.
Okay.
So that's it's the sum of all payments that you're making, because obviously if you generate $1 of revenue, you're not just funding debt service with it. You've got to pay employees, you got to pay rent, you've got to do lots of things with that dollar, and then hopefully still squeeze some profit out of it.
Yeah.
It's a rule of thumb for us.
That would assume you have a very profitable and growing business to be even able to sustain 30% in that.
Yeah, it assumes you have a high gross margin business.
Yeah.
The more gross margin you can start with, the more you can flex into the rest of that income statement. If you're shipping a heavy product, that fulfillment takes your CM2 down. If your marketing spend in your product category is just expensive, you have to rationalize the plan. All of it eats in. We typically see businesses, they've cut the bloat, right? They've found that they could do a lot more with fewer people, bringing in outside agencies or consultants that help in the way that Austin and his team can certainly help strategize with your brand. And the more you have in there in terms of efficiency, it's a constant battle, right? It's whack-a-mole where if one problem comes up and you got to arrest that, go fight another fire.
Makes total sense. All right, let's do a quick round of story time. I don't know who's got good examples, but one of the questions that we came up with or was trying to sort of say, you know, getting down to sort of real world examples to kind of bring all this together. What's the worst mistake or sort of misstep that you've seen a founder or a team make when it comes to either raising or taking too much money or too little money? Or what are some things gone wrong here that can serve as a cautionary tale for the management teams on the call?
I'll start. I think what you just said is the thing that we see the most often, which is you take as much capital as someone offers you, and you don't spend the time that Andrew's talking about planning up front. We love it when we see customers that come to us and they've done a lot of careful thinking beforehand. They've done a lot of cash flow modeling, and they know exactly what their business can sustain. I think especially a couple of years ago, a lot of working capital funds or debt providers were applying customers with a ton of capital. And if it was debt capital, there's a lot of risk in that. I think sometimes if you haven't thought carefully up front, you haven't done careful planning, cash flow modeling, etc., then you can find yourself in a pile of trouble later. This is something that, especially these days in a high rate environment, we like to spend a lot of time talking to our customers about exactly what their modeling shows. And we like to help our customers model their cash flows. It's not a service that we charge for, but it's best for us because we want to be sustainable. We want to make sure when we send out capital, it comes back to us. We want to make sure our customers are thinking carefully and are planning in a sustainable fashion.
One of the biggest mistakes that we see is brands using debt as equity. So using debt to fund operational losses, because eventually if you continue to use debt, if that debt is very readily available and there's a lot of capital being thrown at you and use the debt in order to fund operational losses, you get quickly upside down on your asset to liability ratios. And it's very hard to dig yourself out of that without then raising equity at a distressed level in the future, or eventually having to create the profits in order to repay that debt. Otherwise, you get into a pretty difficult spot because eventually the debt needs to be repaid. So I would say one mistake that we've seen brands make is using debt as equity and not having the right balance there. I would say the other mistake that we've seen brands make is not necessarily researching or vetting their lender enough. It's a big, important relationship. We do tons of diligence into companies. We try to understand everything from the way the founder thinks about things, the way the business is run, operational metrics, sustainability, et cetera. Researching and understanding the lender, how they behave, how they have behaved in different situations with other portfolio companies is pretty important. Are they going to stand by what they said in terms of supporting the growth in the future? How do they react if there is a rough patch that you go through? Are they going to work through it with you, or are they going to be less flexible? Are all pretty important. If this is your company, this is blood, sweat, and tears into this. So understanding which partner you choose is pretty important. We don't see enough brands really researching their lender enough.
I echo that wholeheartedly. Whenever a brand actually comes to us and says, hey, can we talk to one of the other companies that you funded? It's oftentimes one of the best ways for us to shine as well. The one for me is always founders high-fiving each other for really high valuations on the equity side. And it's something that feels good at the time. You diluted yourself a lot less. You did whatever else, or you had subsequent funding rounds because you've had some success and you want to raise off the back of that without a plan. I think those types of things just breed inefficiency, right? You've got a ton of cash in the bank. All of a sudden you're going on a hiring spree. You're trying to do all these projects that maybe shouldn't hit a hurdle rate that they otherwise, you launch a new product category. So you stretch yourself out too thin and try to fit to that new capital.
Yep. All good stuff. I think the lack of a plan certainly can hinder all kinds of different things. And that's a nice plug for what we do. So as a final thought here, we did not get a flood of questions from our attendees, but I'll ask everyone to kind of end. We'll do a quick lightning round. Maybe we start with you, Andrew Connaughton, of just kind of like, if you had, one piece of advice for a founder going out into these markets, one final thought, 10 seconds or less, what would it be?
I would just probably echo the point that Mark just made. Just do your homework on the lender. Every lender wants to be your partner when things are good, but understanding what happens when it's choppy sailing is super important. That stuff is just super paramount and obviously not a quantitative thing. So keep in mind that piece.
Yep. All right, Mark, we'll come to you next.
I guess piece of advice would be open and transparent with your lender. I know it's a scary thing to surface problems and kind of even give a heads up that things aren't going perfectly. But from a lender's perspective, a surprise is the worst thing that can happen. Calling you the day before you can't make a payment is my ability to be flexible and work with you through that is going to be a lot more limited if things aren't going perfectly. We don't expect things to go perfectly. We understand that there's a lot of challenges and difficulties. We want to work through all of those things with you and be supportive. But if you're open and transparent and have that dialogue, partnership, communication with the lender, we have a much greater ability to do that.
I would say understand how much capital you need, why exactly you need it, i.e. your use of proceeds point, and find a partner who understands the space you operate in. Also, do detailed cash flow and financial planning. If you can't do it, you're the founder and you're focused on the product, find someone who can. Also look for partners, Clearco is one of them, that can help you think through that stuff. We just published today something on our blog about cash flow modeling. And so we love it when customers want to understand, well, how do I do this? How do I do this kind of planning? Because that makes them better customers of ours, and it makes us better able to tailor our product to their needs.
All right. Last word, Alex, for that.
Sure. Financial planning is sometimes a bear, and we know that founders have a million and one other things to do. Obviously, it's important, it's strategic. Sometimes it's important to say no to capital, just period, end of sentence, right? We've found some brands that had to re-rationalize their business plan and think through whether they should get a larger, credit facility. And even though we saw an ability for them to do that, strategically, it didn't make sense. So not to kind of shoot ourselves in the foot here, we're in the business of deploying capital. But obviously, we appreciate when brands and companies are thoughtful to that end and saying, you know what, our marketing spend efficiency is not great. So we're going to take the next 3 months, really think through whether or not, we want to plow more money into this.
Awesome. Well, I love that. I think scenario planning and forward planning is obviously a superpower that can unlock a lot of value for your business. That's why we started the company that we did. But I want to say thank you guys so much for your time, energy, both in preparing for this and showing up. We'll have all kinds of ways to rebroadcast and find this content after the fact. Thank you to those who showed up, and a great rest of the day. Thanks, everyone.
Thank you.
Thanks.
Thanks.